All right, so pre-COVID, we were in an environment where you could be a bit less discriminatory and kind of get away with it, right? You buy the market, things go in your direction, and you can kind of sleep at night. Going forward from here, it's going to be a lot more important to be more discerning and a bit more selective on where you deploy capital, not just across broad asset classes, but within those asset classes, looking at what sectors that you allocate to, right? So in looking at the fixed income space, right, we face a few broad overarching themes, right? So we're still leaning towards the upside with the Fed and their interest rate policy, right? What that means for the bond side is that you don't necessarily want to have too much of that corporate duration exposure, because again that's more sensitive to
corporate duration exposure, just long dated bonds.
Yeah.
Okay.
Because of the sensitivity to increases in interest.
So what kind of time span? Should I stay within 3 years, within 2 years in terms of the bond maturities?
So lower duration, you're looking at below 4 years.
Below 4 years, okay. All right, continue.
Right? Yeah. So again, within this environment, if you're looking into investment grade corporate bonds, you want to skew shorter term, right? Be mindful of the industries that you're allocating to, and I would have touched on some of them earlier within the environment that we face.
So, well, I mean, just reiterate it. What kind of industries do you like?
Yeah, so again, those non-cyclicals, the consumer staples, healthcare, energy, because of what's been happening in that industry. Prices, the price environment is a bit more favorable. Those companies, they've used the increase in profitability to really shore up their balance sheets from a leverage standpoint. So they're not really investing in new capacity in a heavy way, right? The regulatory environment in that space is also still pretty adversarial, if you want to put it that way, to energy companies. So longer term, you're not really looking at any major above trend increase in production capacity, particularly in the oil and gas space, right? Which bodes well for the future of the price environment, right? Which again will filter back into the cash flow of these companies, which at this point are setting themselves up for a more favorable leverage and solvency position, right? So that kind of underscores the favorability of that space and why we see some opportunities there.
Okay.